China has just changed the silver game, and most investors haven't even noticed yet. You might have seen silver spike past $80 and thought it was just another crazy market move. But what if it's not? What if this is the start of a massive structural shift that could redefine the entire silver market? When supply and demand fundamentals change this drastically, silver can move incredibly fast. Think back to any major commodity shift. It happens almost overnight. In this video, we're going to break down exactly what's happening. We'll uncover the truth about the physical silver shortage, expose China's new export crackdown, and explain what it means for you and the market. By the end, you'll understand why 2026 could be the year of the real silver squeeze. Let's start with the elephant in the room, China's export crackdown. Just recently, in 2026, China implemented strict new licensing rules that severely limit the amount of silver they export. Why would they do this? Simple. They need it for themselves. China is keeping its silver for critical industrial uses like electric vehicles, next-generation solar panels, advanced electronics, and the massive AI data centers they're building. This isn't just about stockpiling a precious metal. It's a strategic move to secure their technological future. History shows us that when a major supplier restricts exports of a crucial commodity, the market reacts, and it reacts fast. Remember when rare earth mineral restrictions were put in place? Prices skyrocketed. This is a huge deal because the global supply chain has relied on Chinese silver for years. For investors who only watch the paper price on a screen, this fundamental supply shock is flying completely under the radar. This brings us to a crucial distinction: physical versus paper silver. It's a concept many investors ignore until it's far too late. Physical silver is the real deal, the coins and bars you can hold in your hand. Paper silver, on the other hand, represents claims on silver through instruments like ETFs and futures contracts. Here's the problem. The price of paper silver can completely disconnect from the reality of the physical market. Imagine this scenario. News of the shortage spreads, and thousands of investors rush to buy physical silver. They go to their dealers, but the dealers have no inventory. Premiums, the cost to buy physical metal over the spot price, start to soar. You might see the paper price on your screen at $85, but to actually get a physical ounce in your hand, you're paying $100, $120, or even more. This divergence happens because there are far more paper claims to silver than there is actual physical silver available for delivery. The paper market can keep trading, but the physical market grinds to a halt. Now, let's talk about why this demand is so unstoppable. This isn't just about investors buying coins. We're witnessing an unprecedented surge in industrial demand. First, there are electric vehicles. Every EV battery management system requires silver. As the world transitions to EVs, that demand is locked in. Second, solar panels. The green energy revolution is built on silver, as it's the most conductive element and essential for photovoltaic cells. And finally, the explosion in artificial intelligence. AI data centers and the advanced electronics that power them are consuming silver at an astonishing rate. Let's put this into perspective. Industrial consumption is now measured in hundreds of millions of ounces annually, and current mining supply simply cannot keep up with this exponential growth. This isn't speculative demand that can disappear overnight. Industrial demand is sticky, it's persistent, and it's non-negotiable for these global industries. They need the physical metal, no matter the price. So how does all this trigger a real squeeze? It's a perfect storm. You have China, a major supplier, pulling its silver off the global market. At the same time, you have insatiable industrial demand that's growing every single day. The direct result is a severe physical shortage. When there isn't enough physical metal to go around, prices don't just drift higher. They can spike violently. We've seen this before in silver's history. Think back to moments when physical shortages spooked the market. Prices moved in ways that no chart or technical analysis could have predicted. But what's happening now is different. This isn't a temporary disruption. China's policy and the green energy transition are long-term structural changes. This suggests that any price move we see isn't just a spike. It could be the beginning of a new, much higher baseline for silver prices, driven by a fundamental, real-world scarcity. This is where the paper market becomes dangerous. Relying on ETFs and futures contracts might give you a false sense of security. These paper instruments are designed to track the spot price, but they may not reflect the true scarcity of the physical metal. If a full-blown squeeze happens, what occurs if the custodians of these funds can't source the physical silver to back their shares? We could see a situation where physical premiums skyrocket to unprecedented levels, maybe 50 or even 100% over the paper price. So while your ETF statement says you've made a gain, trying to convert that paper wealth into real physical silver could be impossible or incredibly expensive. You might be winning on paper, but losing in reality. The paper market is a tool, but in a physical crisis, it can become a trap. So what does all this mean for investors? This is not financial advice, but a call for awareness. The key is to understand the game you're playing. Acknowledge the risks and the dynamics between the paper and physical markets. Many investors make the mistake of thinking they're one and the same. They might see a dip in the paper price and sell, not realizing a physical supply crunch is just beginning. Or they might hold only paper assets, believing they're safe without understanding the delivery risks. Flexibility and timing are everything. Educating yourself on how supply chains work, how industrial demand is evolving, and how historical shortages have played out is more important than ever. Don't be the investor who ignores the fundamentals until the headlines are screaming about a crisis. Let's recap the key takeaways. First, China's 2026 export crackdown has fundamentally altered the supply equation. Second, unstoppable industrial demand from EVs, solar, and AI is creating a baseline of consumption that mining can't meet. And third, the massive divergence between the physical and paper markets means that what you see on the screen might not be what you get. Put these three factors together, and you have the perfect recipe for a historic silver squeeze. Most investors are looking at charts, at old patterns, at what the central banks are doing. They won't see this coming until it's already here, and by then, it will be too late. The lesson is that fundamentals, especially in the physical world, always win in the end. Thank you so much for watching all the way to the end. I hope this gave you a new perspective on the silver market. If this helped you see things differently, please hit that like button and subscribe for more deep dives. I want to know what you think, so comment below. Is the 2026 silver squeeze real, or is it all just overblown hype? Let's get the conversation started. Until next time, stay aware, stay prepared, and keep learning.